In this video, I would like to discuss how market indices work. How do market indices, how do they work? How do they function? I want to equally explain, key concepts that relates to market indices. Understanding market indices, is crucial for investors to gauge overall market performance. Not only that, you equally track, specific sectors or make informed investment decisions. And so here is a comprehensive overview of the working mechanism, the dynamics, involved, and the key concepts of market indices. Number one is definition of market indices. The definition, the meaning of market indices. So the market index here is it's an index that tends to x-ray a statistical measure that represents the performance of a specific segment of the financial market. A typical index tends to x-ray or display the performance of a segment, a sector, or a section of a financial market. It is composed of a selection of stocks or other assets that are used to track and gauge market trends. And we'll talk about an index here. Usually, if the stock market index, it will involve a selection of certain category of stocks. These stocks are brought together to form what is called an index. You have a typical example is the Standard & Poor, the S&P 500, representing the 500, highest capitalized, company in the New York Stock Exchange. Not only that, number two is purpose of market indices. The purpose of a market indices. What exactly, is the purpose, the need, the role, these market indices play when it comes to investing or investment, procedures. Number one is benchmarking. Indices serve as a benchmark for comparing the performance of individual investments or portfolios. They are there for the sake of comparison. When you have indices, you can compare the performance of a particular investment portfolio against some other investment portfolios. Not only that, it's equally there, to kind of, show the effect of market trend. They provide insight into the overall health and direction of the market or a specific sector. It helps you to understand market trend. If a particular index is doing very well, it shows that the stocks that comprise that index, that index, the stocks that form the constituents of that index are performing very well. Not only that, you have investment products. Many investment products like index funds and ETFs are designed to replicate the performance of a specific, indices. And so, because of the idea of indices, you have products like ETFs. They reflect the performance of certain indices. You equally have asset classes like index funds. They're equally there to mirror the effect, to mirror the performance of whatever index they are benchmarked against. So the purpose here is for benchmarking, for market trends, as well as to provide investment products. Number 3, types of market indices. Types of market indices. Number 1 is broad market indices. And these indices track the overall performance of a large segment of the market. A typical example is the S&P 500. You equally have the Dow Jones Industrial Average. So they are there to track the performance of the broader markets. Not only that, we have what is called the sector indices. These indices they are focused on specific sectors. Example is the NASDAQ 100 for tech stocks, as well as the XLF for financials. So when we talk about the NASDAQ 100, it comprises the top 100 stocks in the technology sector. And not only that, we have the international indices. This represents markets outside of your home countries. Example is the MSCI World Index and the FTSE 100. These are international indices, indices that are found outside the United States. You equally have, bond indices. They track the performance of various types of bonds. Example is the Bloomberg Barclays US Aggregate Bonds Index. So even these bonds equally have their own index. So they track the performance of different classes of bonds. And so the types here, once again, to recap once again, you have broad market indices, you have sector indices, international indices, as well as bond indices. Number 4 is common market indices. We want to highlight, the popular common market indices we have. Number 1 is the S&P 500, very, very popular, representing 500 of the largest U.S. companies, and is often used as a benchmark for the overall U.S. stock market. When we talk about the performance of the S&P 500, we are more or less, emphasizing the performance of the overall market. The other one is the Dow Jones Industrial Average. The Dow Jones Industrial Average. So it's composed of 30 largest publicly traded companies in the US, focusing on blue chip stocks. The focus here is on blue chip stocks. One of the videos I highlighted the features, the characteristics, and the key, features of blue chip stocks. So this particular index tracks the 30, largest blue chip stocks in the market. You have the NASDAQ composites. The NASDAQ composites here includes over 3,000 stocks listed, on the NASDAQ exchange, with a heavy weight, towards technology companies. So this particular index comprises, over 300. Unlike the S&P 500, just 500 companies. In this other case, you have as much as over 300 companies. So they tend to be focused on technology, technology companies, companies in the tech sector kind of. You equally have the Russell 200, or rather the Russell 2000. It tracks 2,000 small cap US stocks, and is used to gauge the performance of smaller companies. This particular index tends to mirror the performance of smaller companies in the markets. So they track over 2,000 small cap stocks in the market. And again, I want to recap. The indices here are the Standard & Poor's, the Dow Jones Industrial Average, the NASDAQ Composites, as well as Russell 2000. Then number 5 is index calculation method. How do we calculate, the indices, index calculation method? Number 1 here is price weighted. Price weighted. So the index value is calculated based on the stock prices of its constituent companies, with higher price stocks having more influence. It's like combining the prices of totaling the prices of the individual stocks that constitutes the index. Supposing, for instance, you have just an example, you have, let's say, 100 stocks in a given index, and let's say each of the stocks is valued at maybe, let's say, $1. That means the entire index will be $100. That's an oversimplified example. So you have the market cap weighted index, the market cap weighted method. Constituent companies were weighted according to their market capitalization, with larger companies having a bigger impact on the index. Example is a typical example is Standard and Poor 500. So in this particular context, you discover that the companies are arranged according to the market capitalization. The highest cap the highest cap companies having a larger influence on the price or the pricing or the value of this index. The other method is equal weighted index. That's the one I earlier explained. Sorry, that was the one I earlier explained. So all constituents are given equal weight regardless of their market capitalization or stock price. That's what I earlier explained. Sorry. That means that if you have 100 companies here, they are equally weighted. They carry equal weights. There's no kind of one having advantage over the other. They are equally weighted. In the first instance, you have price weight. That will involve the price of the constituent companies. The other one is market cap weight. That has to do with the market capitalization of each company. And this other one is equal weight. That's all constituents are given equal weights. Number 6 is rebalancing and adjustments, periodic rebalancing. So indices are rebalanced periodically to reflect changes in the market or economy. This may involve adding or removing companies based on specific criteria. They have their criteria for adding or removing a company from the index. If a company performs poorly, that company could be dropped and be replaced by a better performing one. And so you have this regular rebalancing, and not only that, you equally have adjustments for corporate actions. So indices are adjusted for stock splits, dividends, and other corporate actions to ensure accurate representation. When it comes to adjustments, in this case, they consider stock splits, they consider dividend payment. They equally compare corporate actions like like when they release their results, when they pay out dividends and all those things. These are examples of corporate actions, and they influence the adjustment being carried out in the indices. So when it comes to rebalancing and adjustment, you have periodic rebalancing, and you equally have this other one is time bound. They do it regularly, periodically, to reflect the nature of the economy. It might be quarterly, it might be biannually, it might be whichever time frame they want to adopt. The other one is an adjustment for corporate action. Whenever there's a corporate action announcement by the company, then of course adjustment is done based on these actions. Please subscribe to this channel, and don't forget to like this video, and press the notification bell so as to be able to receive any content produced on time. You have number 7 is how to use market indices. You have performance comparison. So you compare the performance of individual stocks or portfolio to the relevant indices to assess relative performance. Usually you compare the performance of the individual stocks or portfolio, and then you weigh it against the indices, the relevant indices, to compare precisely the relative performance one against the other. Not only that, you have investment strategy. You use indices to guide investment decisions, such as investing in index funds or ETFs that track specific indices. You want to invest in an in an indices or in an index, you have to look at the fund or the ETFs that tracks that particular index or indices, as the case may be. So they are there to hone your investment strategy as an investor. Number 8 is limitation of indices. I think I will find time to produce a separate content on how to use the index, and also on the limitation of the of market indices. So you have bias. Some indices may be biased towards certain sectors or large companies which might not represent the entire market. Let's say the S&P 500, it is biased towards highly capitalized companies, and they have nothing to do with smaller companies. If you equally consider the Russell 2000, they are only limited to kind of smaller companies, and they neglect the larger cap companies. So these are biased towards certain market capitalization, and this bias will hinder a typical index from reflecting the overall performance of the entire market. So apart from you equally have historical focus. So indices are based on historical data and may not always accurately predict future performance. So the way when it comes to including a company, or companies in an index, we are doing that based on their past performance or past performances, and that may not really reflect how the company will perform in the future. So they are historically biased. So understanding this aspect of market indices can help investors make informed decisions, track market performance, and tailor their investment strategies effectively. So you take your time to go through this video again and consider how indices work, how they are calculated, the advantages and the pitfalls, the types of indices, the purpose of indices, and even what indices are all about. It will go a long way in educating you as an investor. So when you have a particular result in the market, you ask yourself, have I been able to beat the index or not? So they serve as a benchmark for you to now serve as a yardstick or a benchmark or a standard for judging your performance in the market. You cannot do without the knowledge of how these indices operates and their influence on the overall market's performance entirely.